We talk about the drawdowns, and oftentimes those drawdowns can trigger behavior, whether it is about kind of getting in at the right time or out at the right time. We know that timing the market is one of the toughest things to do for any investor out there. To that point, Bryon, what I'd like to do is talk about one of the larger ETFs in terms of AUM that this product that Innovator is putting out, and that's the BALT, the BALT ETF, which is basically an S&P 500 tracking instrument that puts those kind of buffers in place to limit upside and downside at the same time. If you look at the one-year chart, it's pretty telling, right? That one-year chart goes back and shows the kind of tariff tantrum in the markets from April. If you look at the way that the market spiked lower, and you look at the BALT ETF versus the general S&P 500, you can kind of see that blue line on the screen there is the BALT ETF, the one that kind of caps exposure up or down, right? You know, to some of those moves. Meanwhile, the orange line there is the S&P 500 ETF that everyone knows, right? The spider. What exactly is the benefit, right? Why would somebody want that blue line on the screen as opposed to the orange line, even though they know that the orange line over the past year has more than doubled the return of the blue line BALT ETF?
Yeah, I think Nick made the perfect point, and he's expert at talking about this as well, but investor behavior sometimes drives your performance much more than the point-to-point on January 1st to whatever we are today, December 8th. If you weren't invested going into this, you didn't get that exposure, and so there's a lot of cash on the sidelines right now. And so if I'm a investor or a financial advisor talking to clients and I'm saying, hey, I know markets are close to all-time highs, here are the types of tools that we can start to use to get you equity market exposure. That's a really important thing to my practice and to investors to get their long-term returns that they should be getting from equities. At the same time, the market does that, the tariff tantrum that we kind of talked about. If you sell at that moment, you panic, and when do you get back in? Are you getting back in a month later, 2 months later, or are you still waiting for that opportunity to get back in? And so the complementary nature of both of those things, the best portfolios are using all of these tools to design the perfect outcome for what investors are trying to achieve. And so, you know, I think these charts tell a heck of a story there of this is a way to smooth out your ride over the long haul and not try to time the markets, but make sure that you're in the market to participate.
How much, Nick, we look at those two charts, how much is the kind of, I guess, appropriateness for a risk tolerance level in that conversation with you and your clients? Meaning, if somebody is, say, 30 to 40 years old and maybe is okay with the orange line profile volatility and return, as opposed to, say, somebody who's 50 to 60 years old, who maybe still wants that kind of exposure, but is not willing to tolerate the more extreme downside risk. So demographically speaking, it might make sense, but just how much are advisors using it in that context, and how are they marketing that to their clients?
Yeah, I think it's absolutely that. And right, demographics, the age of the investor can play a role, right? We also look at just the individual's, ability, and, that will be ability to take risks, their willingness to take risks, right? Their psychological disposition, and how comfortable are they seeing their portfolio move up and down, right? We do fully believe and recognize that over the long haul, straight, low cost, plain vanilla, passive exposure to the market, highly likely to deliver a superior return over 10, 15 years relative to one where we are building in structural downside protection. That said, not everybody can live from A to Z. What's most important is that we get them from A to Z. These types of products certainly play a role in there, and the age can be a factor. It's just also that willingness to take the risk and deal with the ups and downs. And there's many ways we try to go about trying to assess that. Because also, too, right, an investor's assessment of their risk tolerance today may look very different than it did in March of 2009 or of April of this year. Everybody can say after the market's been rallying strongly for a number of years, of course I'm comfortable taking risk. But we know that it's ultimately those stressful moments when the true investor's risk tolerance shines, and that's where we need to understand and make sure we've built a thoughtfully structured portfolio that can ultimately enable the client to get to the long term.
There's no doubt the ETF market has become much more sophisticated with just the product offerings that are out there, so that there are tools, in essence, to do all of these things. Bryon, the other thing that you mentioned before that I want to hit on here is we talk about these defined outcome type products, these actively managed ETFs as a bigger umbrella. But buffers are not the only thing that are part of that kind of suite of products. There are other types of instruments that use similar strategies to obtain certain targeted outcomes. I can think of income being one of those ones we talk about quite a bit right now. What exactly does the Innovator deal and what exactly is GSAM's overall take on just how much these tools will matter in the coming years and decades to service some of those needs?
Yeah, I think of like the S&P 500 as kind of like an acoustic guitar, and then you can plug it into an amp, or you get an electric guitar and you can make all these different noises out of it, but you still have this kind of reference instrument with that. And so the defined outcome space is kind of that space. So, we talked about income-oriented strategies. The covered call category has grown rapidly over the last decade, and investors are continuing to look for income in their portfolios. And so we certainly see that playing out. Goldman has some leading capabilities on the active premium income side, and so we're participating in that. We've talked about the target buffer thing. We were talking about BALT a second ago. Some advisors talk about bonds in their portfolio as even though you might be a little bit younger profile, you still need to eat your vegetables. And we're actually seeing BALT be used as a bond alternative, BALT. And they're taking that and using it as bonds instead of kind of the core equity exposure as well. And so there's this like third dimension of portfolio construction that's starting to happen with these tools that are happening. And then the third area is kind of these growth areas. And you can get accelerated returns from this. We're seeing dual directionals start to play an interesting way in auto callables as well, which can circle us back around into the income side of things. And so the whole kind of space is you've got this reference asset, and then now using options, relatively straightforward strategies that have been used in portfolios for years now, but the innovation being putting it into an exchange-traded fund and listing it on an exchange is now giving investors all these different dimensions that they can deliver these outcomes for their investors and for their own portfolios.
Bryon, how sophisticated does a user of these tools need to be? Because in essence, what you're talking about are products or strategies that have been reserved for very, I guess, sophisticated investors in the past, but are now very democracy-wise accessible to vast portions of the investor population based upon the use of the ETF wrapper. Just what does an investor or trader need to know about these types of products so that they ultimately do the job that they are supposed to, given the risk-reward profile of each of those instruments?
Yeah, investor education is something that we are completely laser-focused on. If you look at the Innovator website, the tools that they provide for investors to make informed decisions around these are extremely sophisticated, and they're very intuitive and easy to use. We, of course, when we're talking to individuals, talk to your financial advisors, make sure that you're getting financial advice from those individuals. That's not what we're kind of in the business of doing. But what we are seeing is that as investors start to use these tools, they understand how they move, and they're starting to be able to incorporate them into portfolios in that way. So education is always the first thing. When ETFs first came out 30 years ago, that was a big part of it. When fixed income ETFs first came out, 20 years ago, that was a big part of it. Making sure that people understood how these products were going to work and to incorporate them into their portfolio is always kind of paramount. One of the benefits of the ETF is it's on exchange and it's transparent. You can jump on the website and see exactly what you own within your portfolio real time today. And so the ability to educate yourself, understand what you're getting in the portfolio is extremely high. But of course, we encourage people to make sure that they understand what they're buying. That's true for every investment.
Sure. And to kind of cap the conversation off, if we talk, Nick, about just the level of investor sophistication, many of the clients that you service and other RIA service are relatively smart in terms of how they manage their money. They wouldn't be as successful as they are unless they did. But to what degree has that knowledge curve evolved for your clients, say at Kathmere, over time? Are they becoming more sophisticated as the decades kind of go by? Or do you feel as though there is still a general sense of, I guess, maybe a gap in information for how even high net worth investors view some of their instruments?
Yeah, I think as many things, it runs the gamut. We have clients that are very investment sophisticated, right? They enjoy staying up to date on these things, doing the reading, doing the research, engaging me and my team on these conversations, and very much like playing a role in the management of their portfolio. And the information availability in the world today, obviously unprecedented relative to 5 years ago, 10 years ago. And so clients are able to do that. We also have other clients that have been very successful in their professional lives, and they say, look, my expertise is in running my business and building my company, generating wealth. I trust you, Nick, and your team to manage my wealth for me. And so it runs the gamut. Again, Innovator puts a lot of effort into obviously the investor education that comes through on our end and being able to see how these strategies are performing, understand right the upside, the downside scenarios of these. With many of portfolio construction, we ultimately look for that clear line of sight. We at all times with all assets, we want to have a great understanding of what role is it playing in our client's portfolio. How can we expect it to perform in good times? How can we expect it to perform in bad times? That gives us clear line of sight when we ultimately try to build out a diversified portfolio.
All right, one final question to you, Bryon. Goldman Sachs Asset Management, as you point out, very large footprint in terms of asset management on the ETF side of things and everything else. Just what kind of commitment will Goldman be looking to make in the coming years towards the ETF space, specifically when it comes to active?
Yeah, I think we've made a pretty big commitment right now, and we're just going to continue to execute down that roadmap. I mean, we've talked about the Innovator strategy. That also comes with 70 people from the Innovator team that we're thrilled to have. They bring a tremendous amount of ETF DNA to the equation and a great level of sophistication, combined with the existing Goldman Sachs team, which is a really powerful, thoughtful, and well-educated team as well. We think that we've positioned ourselves really well to serve clients going forward, and we're excited about our ETF strategy.